Welcome to the Stock Guy Analysis. Okay, so something absolutely massive just happened in the world of finance. And you know what? It pretty much flew under the radar for most people, but a quiet little rule change might have just completely rewired the connection between crypto and Wall Street. Let's break down exactly what went down and why it's such a ridiculously big deal. So, what on earth does that actually mean? Well, this quote is straight from the official announcement. In plain English, the CFTC, they're the big dogs, the top derivatives regulator in the US. They just gave a massive green light for assets like Bitcoin and Ethereum to be used as the foundation, the bedrock of trust in traditional markets. This isn't just a small step, folks. This is the financial equivalent of building a super right way between two worlds that were previously separated by a rickety rope bridge. All right. So the key to this entire revolution, the engine driving this whole thing, is a concept called tokenized collateral. Now, I know it sounds super technical, but the idea behind it is actually simple and incredibly powerful. So let's get into it. What is it and why does it matter so much? Think of it like this. You take a super traditional, reliable asset like a US Treasury bond, right? And you turn it into a digital token that lives on a blockchain. Suddenly, that bond isn't a piece of paper in a vault anymore. It's a digital asset you can zap anywhere in the world instantly, 24/7, to back up a trade. It's the difference between mailing a letter and sending a text message. Now, to really appreciate just how big of a leap this is, we got to look at how things used to work. The old system for moving collateral around. And remember, this is the stuff that backstops trillions of dollars in trades every single day is, frankly, ancient. We're talking about a system built for a world that existed before the internet. The old way really boils down to three huge problems. First, it's slow. Settlements can take a day, sometimes more. Second, it's expensive. You got all these middlemen and custodians, and they all take a cut. And third, it's restrictive. It only works during banking hours. So, what happens if a crisis hits at 5:01 p.m. on a Friday? Too bad. You're stuck waiting until Monday morning. And that brings us to the new way, all powered by tokenization. This isn't just a little tune-up. It is a fundamental upgrade to the entire financial engine. It's about finally building a financial system that operates at the speed of the internet. Instant, always on, and truly global. And this slide just lays it all out, clear as day. Look at the difference. We are moving from a system that takes a day or more to settle to one that is literally instant. We're going from being locked into banking hours to a system that runs 24/7, 365. And we're going from crazy high operational costs to an automated system that is radically cheaper. I mean, come on, it's a quantum leap forward. Now look, the full list of benefits is right here on the screen, and trust me, it is long. But let's just zero in on the two that are the real game changers. Number one, instant settlement. This is huge because it just yanks a ton of risk out of the system. There's no lag time for things to go wrong. And number two, higher capital efficiency. This just means that assets that used to be locked up, just sitting there doing nothing, can now be put to work earning money, all while still serving as collateral. And please don't think this is just some pie in the sky theory. This is happening right now. We're talking about the biggest names in the business. BlackRock, Societe Generale, Franklin Templeton, the CME Group, they are all rolling out solutions like this. The CFTC rule. Well, that just opened the floodgates for this to go completely mainstream right here in the US. So, how does a big regulatory shift like this actually play out in the real world? Let's zoom in and look at a perfect example. There's a company whose whole strategy seems tailor-made for this moment, and it's a fascinating case study. BitMine Technologies, ticker BMNR. So, BitMine's whole game plan has been to become a massive holder of Ethereum. They've built up this enormous treasury of the asset, and it turns out that strategy aligns perfectly with where the regulators are now headed, which makes them a really interesting lens to look at the impact of this new rule. Okay. Let's talk numbers because this is where it starts to get a little wild. BitMine is holding about 3.73 million ETH. Now, to put that into perspective for you, that is roughly 3% of all Ethereum currently in circulation. And what's that look like in good old-fashioned dollars? Well, that treasury plus their cash is valued at over $12 billion. That is a massive war chest of digital assets that just got a whole lot more valuable and a whole lot more useful thanks to these new rules. And here's where it gets really, really interesting. Before this rule, big players had to make a choice. Either you stake your ETH to earn yield or you use it as collateral. You couldn't do both at the same time. Well, now you can. For a company like BitMine, this could effectively double its potential annual revenue from staking, taking them from around $400 million a year to a potential $800 million. So, how's the market looking at this? Well, when a CFTC basically gives a thumbs up and validates ETH as an institutional grade asset, analysts start to pay very close attention. And right now, some of them are projecting a potential upside for BMNR stock of between 100 and 300%. That just shows you the power of this kind of regulatory shift. So, let's just recap how this all comes together to create a really powerful story for a company like BitMine. 1, they don't have to sell their core ETH holdings just to post margin anymore. 2, their potential revenue from staking could double. 3, the very asset they bet the farm on just got the official institutional grade stamp of approval. 4, it gives them a green light for all sorts of new tokenized products. And 5, it's basically rocket fuel for their stock's narrative. This is not a minor update. It's a massive de-risking event that supercharges their whole business model. Which leaves us with one final very powerful question. For years, the big story has been about all the hurdles preventing crypto from truly integrating with traditional finance. But now, with crypto being officially accepted as top-tier collateral, the very foundation of the entire financial system, are we about to witness that final barrier to mass adoption finally crumble? Thanks for exploring this with me today. If you found this breakdown helpful, do me a favor and don't forget to like, subscribe, and turn on those notifications. That way, you support the channel and you'll never miss our next video explainer. Thank you.